Good morning. This is Arlan Sudeman, Chief Commodities Economist from StoneX, coming to you from the trading floor on this Monday morning, June the 9th, to give you an update on the commodities. And there's a lot of potential here in these commodities. Which way will it go is the question. And we've got a lot of potential news events and some developing news events that I wanted to cover here today. As we look at the commodity sector over the last year, we see that the precious metals, the softs, and the proteins, and that'd be the meats, have been performing the best. Well, the rest of the commodity sectors haven't done so well year on year. So we look at them. That may change going forward, and I'll give you some of the things to keep your eyes on, some of the headlines to watch for potentially. I'm going to look at several fronts today. First of all, let's talk about the Black Sea, Russia and Ukraine. As we look at Russia and Ukraine, they've really stepped up their efforts to strike each other at key strategic locations, and we've seen that really escalate in recent days. One in particular I think should catch our attention, and that was last week's strike on the bridge that covers the Kerch Strait, the Kerch Bridge. That's the bridge that connects Russia with Crimea, the Crimean Peninsula. It moves military equipment and personnel over that bridge to feed and fuel its war efforts in Ukraine. That's not why it's critical. It's critical to Ukraine and Russia for that reason and strategic, but how it affects us in commodities is it spans the Kerch Strait. Now, think back a little over a year ago when we saw the Francis Scott Key Bridge go down in Baltimore Harbor and how it shut down that harbor for quite some time before they could get the bridge structure removed and allow ships to pass once again. This is a war zone, so probably it would take some more time. Now, that's assuming the bridge would go down over the entire way that the channels are, and so that's why I want to preface this, that the odds still may be below 50% this is going to happen, but we have seen now that Ukraine does have an interest in bringing down at least a portion of that bridge. It hit the pillars with bombs last week that, according to reports, did substantial damage to those pillars, but not enough to bring the bridge down. What if they strike again? What if they're successful next time? Now, of course, it depends how many spans come down. But if you look at what passes under that bridge that could be at risk here is 30% of Russia's wheat exports. That would be about 13 million metric tons per year wheat exports that pass through that, divided by however long it takes to get those spans cleared so they can move once again. And we're coming up on the Russian harvest now when their export desire is going to increase dramatically. The other is 1.5 million barrels per day of crude oil that pass through there as well. So the energy and food grain markets could significantly be impacted if that happens. So it's a headline to watch for. We haven't really seen this cause a lot of desire to go long in these commodities, but what we have seen is fund managers holding short positions want to unwind some of those short positions. That has crude oil testing 2-month highs today at the $65 level roughly in WTI crude oil. That has wheat covering short positions rising as well overall. Now been weaker today, but last week we saw a significant amount of short covering strength in it. And again, not enough to really essentially change the fundamentals today, but watch the headlines regarding that. Now let's look at China. We continue to be in a trade war with there. China has built its economy and its military war machine based in part on trade surpluses. One of the largest of those trade surpluses that sends revenue into China in order to help finance and provide the revenue for developing its economy and its military is the United States has that big trade surplus. It used to ship $450 billion per year of goods to the United States. And that essentially got shut off until the 90-day pause was signed on May the 11th. And President Trump had a conversation with President Xi last week because China wasn't following through in issuing export licenses for rare earth minerals. We've become dependent on rare earth minerals coming from China, like China has become dependent upon access to our consumer market. Now, those rare earth minerals, had we not got that going again, we could have seen the production of automobiles here in the United States start to come to a halt here within a couple of 2 to 3 weeks, according to some sources. And it's also essential for our military equipment. Now, China is going to try to prevent us from getting rare earth minerals for our military equipment, I believe. It has taken steps to try to control who those rare earth minerals go to, but it has started to issue some export licenses since that call, which is something else of note. Each time we've had high-level discussions with China, we have had some sort of an agreement. And so, as negotiators from China and United States meet in London today, don't be surprised if we have some sort of an agreement, and the markets will take courage from that. I don't expect it to solve all of our differences by any means. That's going to take months, in my opinion, if not years, if they ever get settled, because really China and the United States are in a battle for the 21st century. Who's going to control the 21st century, essentially? Very vastly different value systems on which their economies are built. And so that's not going to be settled in a trade agreement. But I could see the possibility at some point of a trade agreement with China, which would give them favorable access to our consumer market that I mentioned in exchange for buying our commodities, our ag and energy commodities in particular. So that is something to keep your eyes out for the possibility as we go forward. Number 3, U.S. Biofuel Program. That's dependent upon three pieces to this puzzle. The one is what the RVOs are going to be. Essentially, the blending mandates are going to be. And the EPA has developed those recommendations and sent them to the White House Office of Management and Budget, where they are being reviewed. And we expect to hear any day now, over the next week to 10 days, what those are going to be. The second is the small refinery exemptions. Now, we expect the EPA to rule very soon also on the SREs that were applied for in 2024, while working on a process to clear the backlog of SRE requests going all the way back to 2016. In the end, it's going to matter what the net number is between the RVO and the SREs. We believe it'll be a positive number for demand for edible oils produced here in the United States. But anything is possible. But that's to keep an eye on. That announcement's coming out soon, we believe. The other is the funding mechanism for the biofuel program, which is called the 45Z, and it was generally a favorable 45Z guidelines for the program in the House version of what they call the Big Beautiful Tax Bill. The Senate, though, is still unclear what they're going to do with it. And so those three components are key for domestic demand for soy oil, soybeans, and even for corn and ethanol, because one of the critical things in there was the removal of the indirect land use charge that had been penalizing U.S. commodities being used for biofuel. Yeah, will that survive the Senate is a key question, but if so, that could be very positive, not only for soy oil demand, canola oil demand, but for ethanol demand, which is made from corn. And finally, we have the meat sector, the protein sector, we'll call it, as we continue to have very low numbers of inventories of cattle to slaughter here in the United States due to a multi-year drought in the West that's reduced the size of our breeding herd. And now we've started to slow, at the very beginning stages of rebuilding that breeding herd, which means we're holding back heifers from the feedlots, just the early stages now, but that's tightening our supplies even more because of cheap feed prices. We've been feeding animals to heavier weights, heavier carcass weights, record carcass weights, and we're importing at a record level. But that's still not enough to fill the demand. And keep in mind, this is in an environment where our diets are focused on what's been popular right now, focusing on protein, especially related to the GLP drugs that people are taking that change the diet, alter the diet from a protein to from a starch more toward a protein-based diet. So even at these high prices for beef, we're seeing a resiliency of demand to this point that is continuing to support these record high cash cattle prices that we're seeing right now. So those are things on my calendar, they're on my attention, on my focus that I'm watching this week in these markets. Like and subscribe if you want to continue to get these updates from the trading floor, and I plan on being back with you as more develops. Thank you.